Hello traders! Today I'm teaching you an insane forex and crypto trading strategy that actually works. We are going to use liquidity inducement trading and smart money concepts or ICT trading strategies. But we use those inner circle trading strategies that actually works. With this insane forex and crypto trading strategy, it doesn't matter if you are a scalper, a day trader, a swing trader, or a long-term trader. It works in every time frame because it's a very fractal and reliable kind of strategy. I even forward tested it for you 100 times so you can see the results at the end of the video. And did you know that the biggest portion of self-made millionaires are investors and traders or are in finance? So you can do it too. Let's see what you will learn in this episode. You will learn risk management and money management, higher time frame analysis, and role of fundamentals and news and entry setups. This is a full guide, so you should have some required skills to start to trade with this strategy. First is gonna be mastering the strategy itself, but money management is the most important. You should have the ability to control yourself, to always manage your money less than 1% of your account. I mean that if you want to enter a trade, it should be 1% or less. You can increase this 1% to 2% or 3% in the future when you master this strategy and mastered yourself, your mindset to risk 1% of your account, because risking 1% of your account and knowing that is one thing, but controlling yourself to risk that 1% to act upon that thought is another thing. You may have some consecutive losses, so be aware of drawdowns, and you may have some consecutive wins. The most important thing is that consecutive losses doesn't mean that the next trade or the next trades are going to be profitable. All the financial markets and trading industry is based on probabilities. You should have an edge and higher probability than other traders. And the percentage of every probability is based on a single probability. For example, if you have 50% to flip a coin and you get a tail or you get a head, it's 50% for every single probability. People think that consecutive heads means that the next tails are more probable, but every flipping of a coin is 50% head or 50% tails. So you may have 20 consecutive losses. And when I say that you should manage your money and risk less than 1% of your account is because of that. The next required skill is going to be risk management. All the gurus think that money management is risk management, but these are two totally different things. Risk management is something like corona, like news events, especially big news events, like geopolitics, correlations between assets, financial disasters. For example, today we have a lot of geopolitical issues, for example, Russia and Ukraine, or Iran, Israel, and Lebanon. These are the news and these are the problems that are gonna have a very important impact on financial markets. So you should have a basic knowledge about fundamentals and you should follow news. You can't trade an asset without knowing its strengths and its weaknesses. You should pay attention to strengths of the asset that you are buying and the weakness of the asset that you are selling. For example, if you are buying euro to US dollar, you are buying the euro and you are shorting the US dollar. So you should know how fundamentally they react to each other, and if the euro is stronger than the US dollar. Maybe the euro is strong and the Japanese yen is weak. So it's better to go and buy the euro to Japanese yen. And trading the financial markets without knowing the fundamentals of your assets is going to be trading the financial markets with one eye blind. The next required skill is going to be real expectations. You may think that it is not an expectation, but you should be very mature to have real expectations in life. All of the amateur traders think that we are gonna come to the markets. I'm the smarter one, I'm more talented. But most of high yield traders have real expectations. In institutional level, they expect 80 to 90% yearly return on investment, and they are less than 1% of traders who are actually making money. And these are maybe 1% of the traders who are profitable, which are only 15% of people who start to trade. So don't think that you are smarter. Don't think that you can make 80, 90% a month. Don't think that you can even make 20, 30% of a month. Let me calculate something for you. Imagine you have $5,000 in your trading account and you are making 30% a month. After 60 months or 5 years, you are going to make $34 billion. Is it real expectations? It's just hallucinations. So don't buy the gurus that they think that they are making 20%, 10%, 15% a month on their investment. It can't be achieved. So you should have real expectations, and those real expectations are gonna save you. Hello, my trading friends. I'm Mehran, nothing fancy here. I keep things real. We are living in the same simple world, and I don't like show off. So it's my room, and we are gonna talk about higher time frame narratives and fundamentals in this strategy. This trading strategy that I'm talking about is enough for you to make the money, but you should follow these steps that I'm talking about. The first is going to be higher time frame narratives about the asset that you are going to trade. You are going to use fundamentals plus higher time frame technical analysis to know that which asset is stronger and which asset is a little bit weaker. Why these are important? Because a successful trader is 3%, 5% better than a non-profitable trader. And these 1% make the difference. For example, you can use only technical analysis to trade every day, but knowing the fundamentals and the weaknesses and strengths of the assets that you are trading is going to help you a lot. We are going to use every tool that we have to make profits and increase our win rate and reward to risk ratio. First is going to be this website that I'm talking about, thefxstreet.com, investing.com, forexfactory.com. These sites are free. I'm not sponsored. They have just good calendars and they have some economic analysis these pros provide you with, and these are for free. You can be a premium member and add something to your analysis, but I think the free membership is enough. But if you like, you can spend a little bit of money to use more tools here. But the important thing is that when we want to sell a thing or buy a thing, what we do? We want to buy a car. We wait until the price of the car is lower than the value that we want to use that car for. For example, the value in our mind for a car is $2,000. When we see that car come near that price, for example, $2,000, $100, $2,100, or it becomes cheaper than $2,000, we are going to buy that car. And in investing and trading, it's the same. For example, now we know that we have a lot of geopolitical conflicts in the world. So the value of something like gold is going to increase. And we know that the Federal Reserve, the USA government, have to decrease their interest rates. So what happens? The US dollar is decreasing in value and the gold value is seeing higher prices. Its sentiment is positive. So when we are talking about the gold, or when we want to trade the gold, we are gonna stay bullish. And the answer is very simple, because when we buy gold to US dollar or we are buying XAU USD, we are giving our US dollars. We are selling our US dollars and we are buying some gold. So when the gold is higher in value and the gold is bullish and the US dollars future seems bearish, it's better to buy gold to US dollar. And another example, you want to sell US dollar because you know that the Federal Reserve is decreasing its interest rate and that price is gonna dump. So you have many options. You can sell US to franc. You can sell US to Japanese yen. You can buy euro to USD. You are selling the USD and buying euro. These are options that you have. So what to do? If you want to buy something like euro USD to sell the dollar, or you want to buy the pound USD to sell the dollar, or everything in front of the USD dollar, when you buy those assets, you are selling the US dollar. You should pay attention to its strengths. So if you see the euro is weak as well, it is not a good option to buy the euro USD because it is not gonna have a very good yield for you. But when you say that the Japanese yen is hiking and you want to sell US dollar, it's better to go and sell USD Japanese yen because you are selling your US dollar and you are buying the Japanese yen on the other side. It's like buying the Japanese yen to US dollar. So you should have some knowledge about the strengths and weaknesses of the assets that are in your disposal and you want to trade. So how this calendar works? Talking about fundamentals is for another episode because this episode is going to take forever if I want to dive deep into fundamentals. But this calendar is going to inform you about the news that are going to come this day or the next week or the next month. And for example, now it's the Fed's Williams speech right now, and you can see this color tag here that shows you the importance of the news. The yellow one is gonna be a very low impact news. The orange one is gonna be the moderate impact news, and the red one is gonna be high impact news. But it is something like the game theory. You should know what is in the mind of the Federal Reserve or central banks mind with reading its every day or every month or every week sentiment, and those sentiments and statements are going to talk you statement those statements are going to talk about the things that are important for the central bank. Then you, for example, you understand that the jobs is very important for the US government, so you are going to pay more attention to non-farm payrolls, which was very off to its consensus and previous numbers, and it is going to have a very good impact on the prices of the markets. So these calendars are the best tools that you can see how fundamentals work. So you should read these calendars and follow the news of those assets that you are interested in, and you are going to grasp something about the sentiment of those assets. For example, you are going to have a positive feeling about gold, and you are going to have a negative feeling about US dollar, and with combining these fundamentals with higher time frame analysis, with higher time frame technical analysis, you are going to say that yes, nowadays it's better to be bullish on gold. Let's talk about technicals. The first thing is gonna be fair value gaps. These fair value gaps are very important for us. And what is a fair value gap? It is a 3 or 4 candle formation. When we have a 3 candle formation and the place between the shadow of the first candle and the third candle is wide open, this is our fair value gap. and you can see that the price is gonna come back. It is gonna fill this place and it's gonna start to go higher. The reason behind these fair value gaps is that many traders are gonna have wrong narratives about the price and start to sell the asset here. And when the market is gonna go up, they are gonna, those players who have the money and the power to do that, they are gonna push the price lower so they can get out in break even or with a small loss. And other players who want to ride the price to the upside, they are gonna stop doing anything in the market. So they are not gonna buy the market here. They are gonna wait until the market comes down and they are gonna buy the market here as well. So fair value gaps are important for us. The 50% of the fair value gap or the close of the fair value gap is very important. And for the bearish one, we can see that here and here we have this space empty and open. This is our fair value gap. The market is gonna fill that and starts to go lower. Another secret that I'm telling you here is that when we have something like this or this, when this empty place is between a blue candle and another blue candle, it's more important, and a red candle and another red candle. Sometimes these are just two blue candles and it doesn't respect this candle because the next candle it's just gonna start to go lower to this place. So if we have a candle here or we have a candle here, it's better. The next thing that you should know about this strategy are order blocks. The order blocks are the last downside movement, this downside movement, before a spike or a strong movement with fair value gaps. And you can see that this order block worked here. And the last up close candle before the down movement, which is a very strong movement in a bearish market, and you can see that it worked here. The 50% of the order block and the open of order block is important, but the 50% is more important. Moving averages. You should use any tools that you have in your disposal to make more money. Moving averages are the basis of very profitable and powerful traders. Those traders that are still in the floors and they are changing the market movements. They are trading a lot of money. I watched and listened to many floor traders, many institutional traders talking about moving averages and RSIs. I'm not telling you that these indicators are gonna have something magical in them, but they are, for example, the moving averages are very good support and resistance, and they show you the trend of the market very precise. Let's talk about the moving averages. They show us the real direction and they are a good support. You can see that we have a bearish order block. These two candles are our bearish order block. Why? Because I told you that the last downside movement before an upside movement, and I said that the 50% of that candle is important. You can see that right here. And we have confluence with moving averages. You can see that it respected the moving average and went to the upside. And the moving averages are showing us a bullish trend. Let's go to the strategy itself. First, we look for an explosive and a strong movement or a spike to the upside or the downside, and it should print fair value gap. You can see that we have a very good strong movement here to the upside and we have fair value gaps here. Then we mark our first swing high or first swing low after that fair value gap. Why? Because these are gonna be early trapped traders, which is this low plus this low as well. You may pay attention that I talked about the fundamentals and the basics of trading world very extensively, because Those are the important things here. I'm gonna talk about these on charts and you are gonna grasp what I'm talking about. But those fundamentals and those basic tenets are gonna be very important, and they are gonna be the guides who will save you. So we see an explosive movement to the upside or downside, which should have some fair value gap. This point to this point is a fair value gap as well, and it is a BC as well. The BC is a fair value gap that got filled a little bit like here. Next, we are gonna look for confluences. Confluences happen when we have 2 or 3 important things happen in the same price and same time in the charts with together. For example, we have moving averages and we have a POI right on that moving average. POI means point of interest. It can be support or resistance, it can be supply or demand, it can be an order block, and plus liquidity pools, which was the high or the low of early trap traders. And the more important thing after those are lower time frame entry setups, which is a pattern. For example, here we have a very good spike movement to the upside, which has its fair value gap here. We have trap traders here, you can see that, which is our liquidity. We have the order block here. The order block always is from the high of the last down movement to the low of the last down movement. When we have a bullish setup, we have our moving averages right there. Even we have some you can see that it is the 50% of this order block, and even we have some 70% OTE here. I'm going to talk about this OTE as well. Sorry for the barking. Let's continue. And the entry setup. So when we found that pattern, which I'm going to talk about in the charts, don't worry if you didn't grasp all of that. It is a little bit complicated for now. You should go and watch this video 2 or 3 times and then have some notes and go and practice on the charts. I'm going to talk about them again, so don't worry. So in lower time frame, we are gonna look for something like this, which is a break of structure here, which somebody may call that change of character. I don't call that. It is a simple break of structure, or you can call it a breakdown to the upside. We have our order block from this point to this point. We have our trap traders again here, and these are higher time frame moving averages. If you have, for example, 5-minute moving average here, you are going to see that the moving average is something like that. Oh, sorry. And we are going to take our trade when this fair value gap gets closed, or on 50% of this order block. It doesn't always happen when the market is very bullish. We are going to enter on close of this fair value gap. The stop loss is going to be here, and it is going to start to go higher most of the time, not always. So you should have a very robust money management plan. Let's see that in action. You can see that after the NFP we have a very good bearish candle, because the NFP for US dollar was bullish, and you can see the results on euro to US dollar. Anyway, we are gonna see some examples on chart, but about moving averages, I use higher time frame moving averages. It is 4 hour and 1 hour, and you can add daily moving averages. So when I go to 5-minute, I'm not seeing the 5-minute moving average. I'm seeing the 4-hour moving average and 1-hour moving average, because I take my entries on lower time frames, for example, 5-minute. If you see that price pattern that I talked about, that higher time frame price pattern, you should pay attention to that. It is B2 time frame higher than your entry time frame. For example, if you see that pattern in 4 hours, you are going to take your entries on 15 minutes or 5 minutes. If you see that pattern on 1 hour, it is better to take trades on 5 minutes. If it is a daily time frame, it is better to take trades on 1 hour time frame. You can write these down. Let's see some examples. So on my chart, I have daily moving averages, which are green, and 4 hour moving averages, which are blue. They are not changed. So on my chart, I have daily moving averages in the color of green and 4 hour moving averages blue. And in lower time frames, these moving averages are not going to change because these are higher time frame moving averages and they stick to the higher time frame, which is 4 hour, and daily. Our entry is going to be 1 hour. Here is our trapped traders. Here is our fair value gap. And you can see the moving averages here. And you can see our order block right here. Let me change that to daily order block. So we have our explosive movement with fair value gap. We have our trap traders right here, and here we have our moving averages confluenced with our order block. And all moving averages are pointing the movement to the upside. So we are going to take trades on lower time frames in this price. Sometimes we don't have a lower time frame setup, but here it is a very good example. You can see that it is 1 hour, it came down, it went to the upside, it broke this high, and then we have our setup here. You can see the confluence between the liquidity points and moving averages. It is a very hard setup to find, but you can see the example is another setup forming on higher prices. When it's near our POI, we can use this setup as continuations. You can see that it somehow breaks this high, but it is a very strong movement. It broke this high, so we have our break-off structure, especially here. We have our fair value gap here. We have our order block here. We have our trap traders here and here. We can enter here and put our stop loss. Right, it is 50%. It's going to be here, and put our stop loss here, and you can see the results. Right after this setup, we have a smaller setup here. We should go to 4 hour time frame. We don't have a very good POI here, but the fair value gap is enough because it's 4 hour time frame, and we have our moving averages here. Because we have a confluence of liquidity plus 3 moving average, you can just take trades on the fair value gap. So we are going to go to lower time frames. On 15 minutes, it's the same entry setup as the last one. Let me show you another setup, and then we are gonna forward test this strategy. Let's have a bearish example in lower time frames, 4 hour time frame, and we are gonna close our daily moving averages because it's a little bit messy. We have that example right here. We have our very strong movement to the downside. You can see that here. We have our early trapped traders here, here, and here, which can, this trade is going to be a good trade as well, but we are going to talk about the last trade. We have our POI right here, which is an order block. And we have our confluence between the moving averages and order block. Another thing is that you should use your order block box like something like here. You can see that I added 10%, 15% to the downside and to the upside of that order block because we have something named inter-market correlations, and that sometimes prevent this price to touch this order block. Why? Because, for example, the US dollar touched this on the dollar index. You may not grab what I'm talking about here, but just add 15%, 10% to this box that you can see I have 45% to 55%, which is my midline, and I have added 15% to the end and start of this box. So it came up. We have our strong movement, we have our fair value gap, order block, and the confluence between liquidity, order block, and moving averages. It is 4 hours. It's better to take trades on 15 minutes. You can see the exact setup that I talked about. It broke this low. It broke this low again, but I'm going to talk about this setup first. It is a good time, and we have our liquidity here. It even retouched the moving averages, so this fair value gap above this liquidity point is our entry. You can put your stop loss here or that high. You can see the results. The next entry will be this entry. This is the exact setup in higher time frame that I talked about. You can see that we have our liquidities here and here. We have our fair value gap, which is still open here. We have our order block here to here, which is this to here, and you can see the midline exactly how I describe it. It touched the midline, grabbed the liquidity. We have a breakoff structure to the downside, and you can see the results here. So this trade is going to be something like here. If you are a little bit aggressive, you can put your stop loss here. If you are a little bit conservative, you can put your stop loss of that, and you can see the result. Let's hop into the back testing of this strategy. I forward tested it for you. Win rate was 56. Reward. I forward tested this insane forex and crypto strategy for you. Win rate was 56. I forward tested this insane forex and crypto strategy for you. Win rate was 56% and reward to risk ratio was 3, more than 3 reward to risk ratio, but we count the 3, and it was above my expectations. In real forex markets or crypto markets, you can't achieve these kinds of win rates and reward to risk ratio. Win rate is gonna go down to 45% or 48%. And the more important thing is that I used my experience as well. So you should get mastered in these kinds of the trading strategies. Another thing is that it wasn't exactly 100 trades. My data went, my data on trading view was finished. I tested it to the last candle I could. So you may have different experiences with different moving averages, different time frames. For example, I used 1 day these moving averages and 1 week moving averages, and I entered the trade on 1 hour time frame with that confluence. Some trades were those trades that, for example, we had this kind of price action and it had its pullback, for example, to here, and then I clicked the stop button here, but I counted them as well. So most of them were uh, forward testing, but some of them like this, it's not back testing or forward testing, it's something between. Because, for example, I entered this trade when this trade was here, I entered that, I put a box here. You can see the green boxes are the profitable trades and the red boxes are the negative trades. Hi, I'm Mehran, your trading companion. This strategy is a wonderful kind of trading strategy. You can use it in every market and every time frame, but you should backtest it first. You should get mastered in it. You should test it on demo accounts and then start to trade with it with real money. Excuse me for boring parts of the video. I'm not a very good English speaker and I'm not an editor, but I know a lot about markets. I know a lot about technical analysis that I can help you in your trading journey. And I was exhausted today, so some parts I'm a little bit tired, but I finished the video for you. Your likes, comments, and subscriptions are gonna help me a lot. I have 2 signal channels that you can enter for free, a crypto channel and a forex channel, especially gold and currencies, but it's almost free. You don't have to pay anything to me. You can just join those channels with affiliation. And another important thing is that if you have any kind of questions, especially about the video, about the concepts, or if you have another kind of question or ask, that you can ask me and I'm gonna help you with. So don't forget to ask your questions in the comments. I'm very glad to help you with those comments and subjects. Thank you for your watching. Have a great week.